Welcome to PolicyCast. Today we are joined by Samir Malik to discuss Ind AS 118, a significant new accounting standard that is set to reshape how companies present and communicate their financial performance. Aligned with the global IFRS 18 framework, Ind AS 118 introduces a more structured approach to financial reporting with enhanced focus on transparency, comparability, and investor communication. But beyond compliance, the standard also raises important questions around systems, reporting frameworks, and how businesses define and explain performance. Welcome to our podcast, Samir. So, please explain what is Ind AS 118 and why should business leaders care about it?
So Ind AS 118 is the latest accounting standard that's going to be added to Ind ASs, which are Indian accounting standards. And as you said, it is based on IFRS 18, which is the global counterpart of the standard. And this is a standard which makes a very significant change to the way financial statements are presented. More specifically, the income statement, the statement of profit and loss, as we call it. For business leaders, it is very important to, I would say, care about it because it paints a new picture to the investors about your businesses. It gives information which is now possibly more relevant to decision making. At the same time, it changes the way our traditional profit and loss were, presented, and that will require some thinking, some judgments, some awareness, and that is, I think, very important change that is coming up because a business's performance is its, statement of profit and loss, and if that changes, the business better be aligned with it.
Yes, so that gives us a very useful starting point. So while Ind AS 118 may sound like just another accounting standard, it clearly has much wider implications for how performance is communicated. Let's now get into what exactly is changing under this new framework. So what are the most impactful changes introduced under Ind AS 118?
Okay, so I'll start with the biggest and the most pervasive change, which is the statement of profit and loss. And now it's going to be defined in three categories, right? So operating, investing, and financing, and with new subtotals. So operating profit, investing total, and the financing subtotal. So basically, the P&L, what used to be, in India specifically, what used to be revenue, expenses, and then, net profit before tax and, after tax, has now completely changed to operating profit, investing outcomes, and the financing outcomes. So that is a very, very important change. It might sound like, these terms are heard of earlier because the cash flow statement was something which was using these terms. However, the cash flow statement had a different point of view. It was looking at cash outflows and cash inflows. And hence, there are differences in how the cash flow statement reads certain of these activities versus how the income statement or the P&L will read some of these activities. So clear differences in principle of classification between, how earlier we are used to as a cash flow statement and now the income statement. So that's an important change. I'll talk about two more changes. One is about the MPMs, as we call it, which is the management defined performance measures. This is effectively a non-GAAP measure. Non-GAAP measure means something that the accounting standard does not require you to disclose. And now these non-GAAP measures are to be disclosed if you have disclosed them elsewhere publicly. So if you, for example, show adjusted EBITDA as a performance measure of your company to your investors, you're supposed to include that in the financial statements, reconcile that with what adjustments you made with the closest available number in the financial statements, and show that reconciliation, get that audited. So it's basically a very, very important change because now the standard is looking at the quality and the consistency and the fact that it will require audit for some of these performance measures. So again, a very, very important change from management performance measure perspective. The third change, I think, is about something which is very India specific.
Okay.
When Ind AS 1 came earlier, there was a carve out. Carve out means that it did not align perfectly to what IFRS, corresponding IFRS had, which is the classification of the profit and loss account by function. India did not adopt that, and now Ind AS 118 allows that option to Indian companies as well. What that does is that it allows you to show your P&L by function. That means you have a function which is production, or a cost of goods sold, or a manufacturing function, and then there's an administrative function, there's a marketing function. Some of these functions will have different employees tagged to them, assets tagged to them, and your P&L could be very functional in the way it looks. Basically meaning that things like gross profit will be more easy to calculate from the P&L. Now, whether an Indian company adopts that presentation or not will depend on how relevant that information is for their investors. But globally, a lot of large companies, actually most of large companies, use the function basis classification to present their income statements. That basically means that this option gives Indian companies to actually present a P&L which is very comparable, which should be a good thing in my view. I just to sum it all, I think overall the changes are aimed at reducing inconsistencies and improving comparability across organizations and industries. So a good change.
Okay, so the changes here are not just cosmetic, they go to the heart of how financial results are structured, explained, and interpreted. So my next obvious question then is, when does all of this actually come into effect, and what should companies be doing in practical terms?
Okay, so there is, there's a complication there. Ind AS is not yet effective while it's in the final stages of approval. So the government is expected to notify it anytime soon, possibly, of course, before the proposed applicable date, which is 1st April 2027. So it is expected to be applicable and effective from 1st April 2027. Yet the notification is pending, which should come in due course, I would believe. The periods, the periods which are comparable periods. So, for example, a company presents its first Ind AS 118 profit and loss account in March 28 for March 28 financial statements. They will have to restate their comparative periods. So that basically means that the Ind AS is already effective in substance. We are already in FY 26-27, and this year will act as a comparative to FY 27-28. So we are already in a period which is going to be applied, Ind AS 118 changes. So yes, that's one case. And the other case, of course, is the fact that companies which are listed will need to apply the standard even in their first quarter reporting. That means June 27 is when they will actually need to report under the new framework. So that and the comparative for June 26 will have to be restated. So yes, it's not too far away. We're already in the period which needs to be restated.
Yes.
I'll cover one more aspect which is very important, again very India specific. India always had a overlay of Schedule 3, which is a Companies Act presentation framework of how the financial statement should look. And that overlay of Schedule 3 is yet to be amended. It does follow, a framework which is very compliant or very aligned to the previous accounting standard, which was Ind AS 1, and now it's going to be amended, and we'll wait to see what kind of amendments we'll see there, but it's expected to be in line with Ind AS 118 requirements, or allow the flexibility to cover all the 118 changes. So that Schedule 3 is an important change which is expected to make way for Ind AS 118. Is that a lot of companies in India are subsidiaries of foreign companies. They are not, just Indian origin companies all through. And because the corresponding IFRS 18 is actually going to be applicable from 1st April 2027, that means 3 months before, Ind AS 118. That means that those companies for their group reporting will actually apply Ind AS earlier. So yes, it's the basically IFRS 18, which is aligned to Ind AS 118 earlier. So that's an important thing to take care of, because then for them the implementation is even closer.
Yeah, so here the timeline is especially important because, as you mentioned, this is not simply a forward-looking change. There's also a retrospective element involved here. And that brings us to the next part of the discussion, that what are the real challenges companies are likely to face during this transition, Samir?
Okay, I would call these challenges, it's just that this transition has multiple dimensions, and all dimensions need to be worked on together. First, it is to understand what impact does it make to your financial statements. So your equity story, your investors, your growth story will all need to align with the new presentation framework. If your operating profit now shows something that is different from what was visible from the P&L earlier, I think that alignment with the management's view is one important aspect or dimension of this standard. So that story needs to be aligned. On the implementation side, though, there are transactions which will involve significant judgment. When you look at your existing books of accounts and you try to split the transactions between operating, financing, investing, there will be significant judgments involved, and those judgments will consume a lot of thought process and good thinking, because those changes will stay with you forever. So that is one side of it. Identifying MPMs, as we said, what do you want to disclose as MTMs going forward? Because you'll need to include that in the financial statements, reconcile that with your actual financial statements, and also get them audited. So something which is very important now going forward. Last but not the least is the tech change, which is that the chart of accounts which are used to prepare financial statements often include items which are single account, which could now be split between financing, operating, and investing activities. And those chart of accounts will need a new set of accounts to identify and track changes for different categories, and then the system logics to actually split those. And one example that everybody takes there is foreign exchange gains and losses. Those gains and losses are currently clubbed and put in a single account all across, whether it's for borrowings, whether it's for trade payables, receivables, whether it's for investments. So all of that will need to now be tracked separately so that it can be clubbed in the respective categories. So important ERP changes coming. Chart of accounts may need realignment. I just took one example. There are definitely more than that.
Yeah, so that's a very important point, because what appears to be a presentation-led change can actually trigger much broader implications across systems, processes, and governance. So with that in mind, Samir, let's close our discussion by looking at how companies should approach this transformation strategically.
Okay, so as we've discussed, that this is not just a minimal compliance change. It's actually a change to how you show your company's performance. So it's definitely early start needs to align with the thought process of the management and the investors, for that matter. organizations should take a structured approach, right? Beginning with impact assessment, followed by redesigning of reporting frameworks, upgrading systems, performing even dry runs to see that, whether you'll be able to meet the reporting timelines and the quality and consistency that is required by, some of the regulators today. So all of that will need time to redesign, rethink. A simple example is consolidation, right? A lot of companies in India, a lot of groups in India have large consolidation structures. And those structures pick up financial statements of subsidiary companies, add them line by line. Those consolidation structures and formats will all need to be changed according to the operating, financing, and investing categories. In some cases, even the classification could change between a standalone financial statements of a company versus a consolidated financial statement. So a lot of thinking needs to happen from that perspective. So early start is definitely a relevant thing. Another example, I think, very critical for Indian environment again is the fact that a lot of companies in India are going to raise funds using IPOs. And in an IPO, you present 3 years of financial statements. If you present 3 years of financial statements, that means that all 3 years need to follow the same accounting principles and presentation principles, which would mean that, while ordinarily companies will only restate the previous comparative, companies going for IPO will actually restate 2 earlier periods in addition to the current period. That means that they need to think even broader. They need to see and convert a past period into Ind AS 118 compliance, which would mean more thinking, more impacts, more alignment with investor stories. That could even affect their valuation to some extent, because the operating profits might actually be visible more clearly or differently than looked at earlier. So very important change to plan and see the impact. I would say, to close it, that if done thoughtfully, Ind AS 118 can actually strengthen performance reporting. It can improve investor communication, and it has the ability to enhance governance to that extent. So that's something I will close with. It's an important change and should be planned well.
Yes, so here clearly Ind AS 118 is not just an accounting update, but a broader opportunity for organizations to rethink how they present their performance and communicate value to stakeholders. That was extremely insightful, Samir. Thank you for helping us simplify what is clearly an important shift in India's financial reporting landscape. As organizations prepare for the transition to Ind AS 118, the focus will not only be on compliance but also on strengthening governance, improving reporting quality, and building greater investor confidence through clear financial communication. Thank you to all our listeners for tuning into this episode of PolicyCast. We will be back next week with more conversations decoding the latest developments shaping business, finance, policy, and regulation.
All right. Thank you.